Hey everyone, welcome back to Corporate Decoder. In today's video, we're going to unpack a really interesting filing from Abundia Global Impact Group Incorporated, formerly known as Houston American Energy Corporation. It looks like they've had to restate some of their financials, which always makes for a juicy read, doesn't it? We will dig into what that means and what it tells us about where this company is headed, so stick around. Before we dive deep, if you like getting the real story behind corporate filings without all the jargon, make sure to hit that subscribe button. And for more exclusive content and to chat with us about these reports, join our Discord community linked right down in the description. So Abundia Global Impact Group Incorporated is filing an updated report because they had to go back and fix some numbers. This happens when, especially after a big event like an acquisition, they realize some things were missed or not quite right in the original accounting. Think of it like finding a few misplaced items after a move and having to unpack a few boxes again to get everything in its proper place. Looking at the balance sheets, we can see some significant shifts, especially between December 2024 and September 2025. Total assets jumped from about $4.1 million to over $28.8 million. That is a massive increase. On the flip side, liabilities also grew considerably from around $6.2 million to over $12.5 million. Their cash position improved quite a bit, going from just over $500,000 to about $1.5 million. That is always a good sign, showing they have more money on hand to operate. However, when you look at current liabilities, you see some big numbers there. They have a HUSO convertible note payable of $4.5 million and a note payable related to a party that seems to be connected to the company for $435,000. These are short-term debts that need to be dealt with fairly quickly. Then there is this Aggie convertible note payable, which shows up as both a current liability and a long-term liability. At the 31st of December 2024, it was about $5.9 million, and by September 2025, part of it shifted to being due within a year, and the rest, around $6.1 million, became a long-term liability. This suggests a significant debt burden that is being managed over time. Now, let's talk equity. Shareholders' equity moved from a negative $2 million at the end of 2024 to a positive $16.3 million by September 2025. This is a huge swing. A big part of that is the jump in additional paid-in capital, which went from about $14.6 million to over $55.4 million. This usually means the company issued more stock or received significant cash infusions from investors, which aligns with the convertible notes and the overall restructuring. The income statement shows a pretty rough picture for the 3 and 9 months ended the 30th of September 2025. For just the 3 months, they reported a net loss of over $20 million. For the 9-month period, that loss ballooned to over $22.5 million. It seems like the business, at least on paper right now, is losing a lot of money. A big chunk of that loss comes from general and administrative expenses. For the 3 months ended the 30th of September 2025, these costs were over $16 million, a massive jump from just $433,000 in the same period of 2024. And for the 9 months, it went from $1.7 million to over $18.6 million. This jump is directly linked to the acquisition of Aggie they mentioned earlier in the report, which included a lot of fees. Another eye-opener is the issuance cost of derivative instruments showing up as $3.3 million for the 3 and 9 month periods of 2025. This sounds complicated, but basically it means they incurred significant costs related to financial contracts that derive their value from something else, like stocks or other financial assets. When you put all that together, the loss from operations is pretty staggering. For the 3 months ending the 30th of September 2025, they reported a loss from operations of over $20 million. However, there is some revenue coming in. The oil and gas segment, the legacy business, brought in about $225,000 in revenue for the 3 and 9 month periods of 2025. This is a start, but it is a tiny fraction of their expenses. Looking at assets, there is a significant new entry, land valued at over $8.5 million as of the 30th of September 2025. The report mentions they purchased a 25-acre site for about $8.6 million to build a plastics recycling plant. This shows a clear strategic shift towards their renewable energy business, which is a positive sign for future diversification. And then there is goodwill, a staggering $13 million. Goodwill is recorded when a company buys another company for more than the fair value of its identifiable net assets. It essentially represents the value of intangible assets like brand reputation, customer relationships, and synergies. This large goodwill figure here strongly suggests the acquisition of Agig was a major event and that they paid a premium for it. Now let's get back to this restatement. The company had to correct errors related to the accounting for a success fee from the reverse acquisition. They say a shareholder paid a $12.4 million success fee on their behalf using shares of the company's common stock. This means the company should have recorded a capital contribution from that shareholder and an expense. This understating of additional paid-in capital and general and administrative expenses is now corrected. They also mentioned some other smaller errors related to debt discount amortization and some casting errors in the equity statement. If we look at the impact of this restatement on the bottom line for the 3 months ended the 30th of September 2025, the net loss presented as restated is $20.4 million compared to what was previously reported as just $7 million. That is a huge difference, meaning the original report was significantly understating the losses. On the cash flow statement for the 9 months ended the 30th of September 2025, operating activities used about $4.6 million. This is a large increase in cash used compared to the $1.8 million in 2024. Investing activities also used more cash, around $1.8 million in 2025 versus $747,000 in 2024. Largely due to the land purchase, financing activities, however, brought in over $7.4 million in 2025, mainly from the HUSA convertible note, compared to nothing in 2024. The company is now reporting in 2 segments, Legacy Oil and Gas, or O&G, and its new renewable energy initiative, Renewables. The O&G segment is generating some revenue, but the Renewables segment is currently pre-revenue, focusing on research and development. For the 3 months ended the 30th of September 2025, the Renewables segment accounted for over $16.6 million in general and administrative expenses, while the O&G segment had revenues of about $225,000. The debt situation is pretty significant. As of the 30th of September 2025, total debt stands at over $11.1 million. This includes the HUSA convertible note payable of $4.5 million, which is due within a year, and the Agig convertible note payable, split between short-term and long-term, totaling about $6.1 million for amounts due greater than 1 year. The Agig note had its maturity extended to January 2027. The HUSA convertible note, for about $5.4 million originally, carries a 7% interest rate and matures in 12 months. The company used the proceeds to buy that 25-acre site in Baytown, Texas. It looks like they are trying to manage this debt and have repaid some of it. The interest expense, including loan discount and issuance costs, is significant, with an effective annual interest yield of about 15%. They also have warrant liabilities. These are basically options that give holders the right to buy stock at a certain price. The company had to account for these as liabilities because they had terms that were not fixed and could lead to variable share payouts. The fair value of these warrants was significantly impacted by the likelihood of future funding rounds. It seems by around June 2025, the probability of a future funding round was deemed remote, bringing the warrant liability to zero on an ongoing basis. In terms of capital stock, they saw a big boost in additional paid-in capital. This is largely from capital contributions and the issuance of shares related to their equity line of credit, or ELOC. They entered into a facility that allows an investor to purchase up to $100 million of their common stock. As a commitment fee for this, they issued 300,000 shares, valued at over $3.3 million. This shows they are actively seeking new capital to fund their growth. They also issued over 236,000 shares under the ELOC for about $1.6 million in gross proceeds in the period. And finally, the earnings per S-share. Given the large net losses, the basic and diluted loss per S-share is negative for the 3 months ended the 30th of September 2025. It was a loss of 60 cents per S-share. For the 9 months, it was a loss of 66 cents per S-share. This is a significant dilution for existing shareholders, especially considering the large number of shares outstanding. So, what is my take on all of this? Abundia Global Impact Group Incorporated is in a massive transformation. They are shifting from a struggling oil and gas company to a technology and renewable energy player. The acquisition of Agig and the purchase of land for a recycling plant signal a clear strategic directional change. However, this transition comes with enormous costs, as seen in the skyrocketing Gordier expenses and substantial net losses. The reliance on convertible notes and equity lines of credit for funding is a double-edged sword. While it provides much needed capital, it also increases financial risk and potential dilution for shareholders. The restatement, particularly the underreporting of losses, raises concerns about the initial accounting rigor, although they do seem to be addressing it. The company's future hinges on successfully developing and commercializing its renewable technologies. The large chunk of goodwill indicates they believe in significant future synergies from the Agig acquisition, but turning that potential into reality requires substantial execution. The oil and gas assets are currently a small contributor, likely serving more as a cash-generative or legacy asset rather than a core growth driver. The biggest risk right now is their ability to manage their debt load and secure continued funding without excessive dilution. The move into renewables is a good long-term bet given market trends, but it is a capital-intensive and lengthy process. In conclusion, Abundia Global Impact Group Incorporated is a company in flux. They are betting big on a future in renewables, but are currently in a very expensive and loss-making transition phase. Investors need to watch their ability to execute on their strategic plans, manage their debt, and secure future funding very closely. Alright, that is our breakdown of Abundia Global Impact Group's latest filing. What do you think about this company's pivot and its financial health? Are they on the right track, or is this a risky bet? Drop your thoughts in the comments below. If you found this deep dive valuable, give this video a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community, linked in the description for more discussions. Thanks for watching and see you next time on Corporate Decoder.